Are you afraid to risk your hard-earned money in binary options? Well, binary options Cashback.com give you an ability to invest your money without the risk of the initial deposit. How does it function? Would you like to invest in binary options but it scares you to think that you could lose your money? 1. Select any broker from our selected web banners. 2. Open an account and deposit the recommended amount. 3. Send us an email to webmaster@binaryoptionscashback.com with the following details: name, broker's name, deposited amount, and the desired method to receive your money back, i.e. PayPal, money brokers, or bank account. And within a short duration of 30 days, you will get the return of the deposit. This advertisement comes with no obligations. We don't require any minimum amount of trades, and you can withdraw your deposit whenever you want. On the other hand, you can open an account with any or all brokers listed and receive a consequent refund.
Hello class, this is Brian from financialtrainingschool.com and welcome to BO 110 Price Spreads. So aside from brokers and charts and strategies, price spreads is by far one of the most popular questions I get. Most newbies fall into the trap of this because they think price spreads is a big issue, but it actually isn't. So first let's dive into the actual problem. So I'll show you guys different brokers and different charting platforms, and I'll show the price spread so that people know what I'm talking about, and then I'll get into the logic behind the solution, and then we'll go through with the solution and the potential problem that could arise. So here we go. As you can see, the 3 brokers on the left and the 3 charting platforms on the right. We have 24 option, Bank to Binary, and Trade Rush. Then we have MT4 with Oanda, Free Stock Charts, and Thinkorswim. As you can see, the prices on the brokers are just like you would see them on the broker. MT4, I have a magnified market price there. Free Stock Charts, you can see the price is on the side, and then Thinkorswim is in the top right there. For the most part, you can see that Free Stock Charts is off by about 0.1 or 0.2 pips compared to the brokers, whereas MT4 and Thinkorswim are off by about 0.9 or a full pip. So depending on the time of day, the pip spread might be different, but the whole point of this video is just to show that the price differential doesn't matter at all. So let's just get started on the solution and the logic behind the solution. So like I mentioned in the beginning of the video, this is by far one of the most popular questions I get. And as new traders, I don't blame you guys, because when I was a new trader, I used to wonder, why isn't the price on the broker the same as the charting platform? Well, the reason being is because they have their information from different servers. So due to different servers, they may have different price information. Thus, that's why you see a difference in prices. The spread now, based on this video and based on the logic I'm about to tell you, is not relevant. And here's why. So I'm just going to illustrate this in Paint rather than actually do this on a PowerPoint because it's easier in Paint. Let's say we have a candle. So I'm going to compare 24 option and Oanda, for example, because this is based on the charts I showed you previously. There's about a 1 pip spread versus the 0.1 pip spread on Free Stock Chart. So I need the 1 pip spread there just to illustrate it so that it's clear. So let's say on 24 option, the candle opens. Let's say it opens like this. So now on MT4, if we draw a line across at the open price, and on MT4, instead of opening at this price, we open at, say, a higher price by the 1 pip spread that we saw previously. So it looks something like that. So let's say the spread is 1 pip, and let's say it's constant, and this is a key to the logic here. So let's say we're trading for 15-minute expires, and these are 5-minute bars. So this is 1 bar, and then we're going to draw another bar, say something like this, and then say another one like this. So let's say this one goes down slightly, and it ends like that. So now this one, basically, as if the logic holds, we're going to have this same scenario except on this side, so that I'm just going to copy it over so that we have something that looks like this, about there. So this is 15-minute expiries. As you can see, we entered on here and the price is lower than this one, and so this is the chart, and we expire here, and this expiry is still lower than the chart price. So the logic is, as long as the price spread is constant, then you should win no matter what. It doesn't matter. It's not relevant. And that's why I don't care about the price spread. Like after about the third or fourth month of trading, when I realized this, I stopped looking at the spread. As soon as you see the entry on your charting platform, you enter it on the broker, because you know that the spread is constant. And this is one of the main criteria that I use when I write broker reviews. The price spread has to be constant. Otherwise, if it's varying, then it's going to be a problem. And I'll show that example shortly. Because it has to be constant, such that when you enter now and the price is lower on the broker than the chart, like it is in this example in front of you, then at this expiry it should still be lower. Thus, when you expire, you should win if you pick the right direction, because the spread is constant. If you entered here for a call and it's lower than the market price, and then you expire here and this is still lower than the market price, then you should win, because that's just logical, because the spread is the same. Versus if, say, the spread was varying. If the spread was varying, then that would be a problem. So let's say we have a spread of something like this. So let's say the spread it started off like this, so that's fine. But instead of having what we had here, we have something that looks like this. So let's just use red for a bar. So let's say it went up, so it went up, and then it started changing the spread. So here the spread is a little different, and then here, instead of going down to there, it drops, say it goes something like this. This is a problem, because see here we started off with price being lower than the market, but now here we end with the price higher than the market, and this is a problem. So this is a varying price spread. So varying price spread is a problem. So that's why when I pick my brokers to recommend, I recommend the brokers that have a constant price spread, or at least overall on average it is constant. It might vary, fluctuate by like 0.1 pips from time to time, up and down, but it's overall it's constant, so it's good enough compared to some brokers which are up and down all the time. So they're up 2 pips and down 2 pips and up 3 pips or down 5 pips or something, and it's just weird. Those volatile brokers, I don't recommend them, because you don't know. You're gambling with those people, because you're not only trading on your own beliefs on the markets, you're trading the broker itself, because what if they give you a wrong price? Then that's a problem. So that's the first logic behind this. What you also need is a constant time spread. So the logic behind time spread is exactly the same as price spread. Price spread, you want to be constant at the entry and the exit. Time lag or time spread, you want to be constant exactly the same as the entry and the exit as well. Because back in 2010 and 2011, this was a very prominent issue, because the earlier brokers, what they used to do was they would delay the expiry. So that was a very big issue, and back then when I wrote broker reviews, time lag or expiry lag or entry lag or whatever, if it took too long to enter a trade or to exit a trade, that was a very big criteria in one of my broker reviews, aside from price spreads. Because just like price spreads, you want to be constant, because if you enter a trade with a 1 second lag, you expect to expire with a 1 second lag. That way it's constant throughout. Because if you were to show this on a chart, for example, so in this example, instead of moving up and down with price spreads, time lag would basically be moving left and right. So we would do something like this. So instead of say we were going to expire at the end of this candle, but instead of doing this, we would say shift this by shifting it to the left, and then such that the next candle, so this white line is where we should have been expiring, but instead of having it expire at the red price, we expire at, say, something like it goes like this. It goes down so that it looks like this instead. So it looks like this. So this time lag is a big issue, because we should have expired at this candle. If we don't expire at this candle where we're supposed to, and we get this one instead, we would have lost. So it's a big issue, and this is a big exaggeration because these are 5-minute bars, but you can imagine the same thing happening on, say, a 1-minute bar. So let's say, imagine this is a 1-minute bar and this is another 1-minute bar, and we're supposed to be expiring right there, but instead of expiring on this minute, it expires on the next minute, and then that causes you to lose. And this is a time delay or time lag in expiry, and this was a prominent issue back in 2010, 2011. It's not that big of an issue now, because the word is out and everybody knows about these issues, and when people know about these issues, bad publicity, etc., nobody's going to use a broker, so it's not that prominent anymore. So most people are focused on price spreads now. Nobody plays games anymore in terms of time expiries or entries or time lags and all that stuff. most brokers, if they do play games, it's based on price spreads now. So that's the logic behind the whole price spread ordeal. So for new traders, don't worry about the price spread. Don't even worry about the time lag anymore. When I write my broker reviews, and hence when I recommend these brokers to you guys, these are brokers that have constant price spreads and constant time lags. So everything's constant, so that you just enter it as if you're trading on the chart on the broker, and then you'll be fine, because it's going to expire on time. The spread is going to be constant, and you'll win or lose based on the chart, and there won't be any issues. So now you guys know what the criteria for my platform issues, and this is why I give heavy emphasis on the platform. I don't really care that much about customer service or even withdrawal times. I care more about the platform issues, and this is why in my broker reviews compared to other broker reviews, I emphasize a lot on the platform issues. I care about the price spread. I care about the time lag. I care about the entry lag. I care about the entry delay, the expiry delay, the expiry lag, everything that could go wrong with the actual trade I care about. I don't care about like the money logistics that much, although that should be a concern, but I care more about the execution of the trade, because that's, by the end of the day, that's where like it all boils down to. If you can't enter your trade properly, you can't even trade, let alone get your money back. So that's not even an issue. The first and foremost problem that I run into is a platform having problems. So now you guys know what I base my criteria on. But that's it for this lesson. As usual, my recommended brokers are 24 Option, Bank to Binary, and TradeRush. Make sure you guys use my links so that you can get an hour of tutoring with me. Full details can be found at ftstutor.com. That's it. Hope you guys enjoyed this video. Thank you for watching, and I will see you guys next time.